We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard, investment manager, Soundmoney advocate, and author of the new book, The Big Print: What Happened to America and How Sound Money Will Fix It. Larry, welcome to the show.
Nice to be with you again, Tom. I always enjoy talking to
you. The feeling is definitely mutual, Larry. You know, I always look forward to getting your perspective and really trying to understand things from your point of view. You know, I always have the privilege of going through your quarterly reports in preparation for these calls. And of course, today was no exception to that. And I want to start off by asking you if we are in the Crackupboom phase of the market right now.
That's a great question. I mean, arguably we are. We don't know for sure, but as we know, stock market's kind of close to making record highs. Gold is very close to its record highs. Bitcoin's close to its record highs. And the bond market hasn't fallen apart yet. So, that's the one piece that's kind of missing in the whole Crackupboom. But it is sick. The bond market is sick. It appears that way, Tom. I mean, when Trump put in when we had the tariff tantrum and the market fell 15%, I thought, okay, that might be it. Maybe this whole bull market and all this stuff is over. But then, of course, he backtracked on that, and we came roaring back once again. Buy the dip worked, and I'm now beginning to think. I've often thought the stock market's overvalued and it was due for a tumble. And I'm now beginning to think, no, maybe it's going to go to just higher and higher numbers for a long period of time, based on all the money that's sloshing around out there. And so now's probably a good time to short the market, because I'm typically wrong, right? So, but when you see all these things making record highs, you have to kind of ask yourself, is this justified? Or is it possible that there's a Crackupboom? And I know we're going to go into the Fed, but I think a lot of this is the market maybe anticipating that sounder or easier money is coming, right? I mean, we've seen Trump, literally attack, aggressively, Jay Powell, and call for a 300 basis point drop in the Fed funds rate, which would take it down into the 1.14, 1.15 area. And, if that happens, bank lending is going to shoot up, money supply is going to shoot up, and we're going to have inflation and more money in the system. So, it's very possible that we are entering a Crackupboom, is I guess the way I view it. Are we in one for sure? I don't know. It's hard to tell.
Mm-hmm. Well, of course, I mean, we're gonna go through the symptoms of that in a little bit, but let's stick with the Fed for now. There was a lot of noise being made about Trump kind of wanting to fire Powell, and whether Powell actually makes it to the end of his term. What do you make of that? And do you think they were putting pressure on him in order to achieve that?
Well, I think there's no doubt they were trying to put a lot of pressure on him and try and push him into dropping rates. I think as a practical matter, it's actually counterproductive, because I think Powell is a Democrat. I don't think Powell likes Trump. And I think that Powell, is looking at his legacy rather than what's good for the country or what President Trump wants. And his legacy is, and as I read it, based on all the things he's said and written, that he doesn't want to be the guy that brought inflation back. He wants to tame inflation in the same way that Paul Volcker tamed inflation, and be, a responsible steward of the money system. And so I think, in light of that, he's very slow on cutting rates, even though the 2-year would indicate that he should be cutting rates. He's not. Mm-hmm. And again, I think he probably knows that we are going to have more inflation in the next 10 years. But I also think he wants to be able to say, hey, not my problem. I stood, I held the wall. I stood firm against the drop money, print, inflate our way out of this thing. And so even though if you go to the CME FedWatch site right now, I believe the odds are in the mid to 80s that they're going to have a cut in September. Mm-hmm. And of course, he's got cover to do it, right? The labor number statistics, the way they readjusted, the adjustments to the labor reports, right, where they showed all these jobs that they had claimed were getting, created, didn't get created. And of course, Trump fired the guy who was doing the statistics there. That gives him a lot of cover. I mean, he could say, hey, our employment mandate suggests that we should cut rates. And maybe he will. I don't know. I mean, that's probably what he should do. And maybe he will. But I don't know. I think that legacy thing is a big deal for him. And all he's got to do is make it until May, which may seem like a long way away, but time travels quickly. And here we are in August, and May will be here before you know it. And I think that the market tends to look through things. I mean, remember, the market is a discounter of future information. And so one of the reasons I think the market's doing as well as doing, the stock market and gold and Bitcoin are all doing as well as they're doing, is that the markets know that when May comes and Powell is gone, they're going to put a dove in there. I mean, a big time dove in there, and rates are going to get cut, whether inflation's under control or not. So I think the market's kind of looking forward on that.
So what do you think the actual, let's say, net effect of that, let's say, rate cut and or QE, if we get there as well, has, let's say, specifically on the markets, Larry? I actually spoke to Mike Green recently. Yeah. He was saying that is actually from a, let's say, income or interest income for the wealthy, a net negative for the market. So, I mean, there's so many different dynamics to this.
There are a lot of different moving pieces. I mean, I actually think it's probably not necessarily that good for the stock market. If you look at the last couple of bubbles, I mean, when they started cutting after 2008, and when they started cutting in 2000, stock market didn't do particularly well. So, if the cutting comes as a result of the economy turning down, and I kind of tend to believe the economy is punk. I don't think it's desperately punk, but I think it's soft. And I think it could continue to turn down. I mean, it's interesting. There are two parts of the economy. I mean, everything connected with AI is cooking. Mm-hmm. But the rest of the economy, I think, is kind of soft.
So, Larry, what do you think the net effect of cutting rates and or going back to QE is going to be? I spoke to Mike Green recently, and there's so many different dynamics to this. One of the things that he brought up was that, let's say, the interest on income that ends up cutting out of the market for the wealthy, and that obviously is a net negative as well for the market. So how do you think this ends up affecting the market itself?
Yeah, he's right about that. Although the wealthy generally have enough that their spending patterns don't vary all that much. I think it's probably negative for the stock market, but I think it's quite positive for sound assets. Gold, silver, Bitcoin. And I think it's inflationary. I mean, one of the things that Trump said and Besant said recently, I thought was very interesting, was, in the beginning of the year, it was all about Doge, and we're going to get this government shaped up. We're going to cut all these expenses, blah, blah, blah. And, of course, Elon fell out with him, and then Vivek went to run for governor, and, 2 trillion became 1 trillion, became 150 billion. Now it's not even clear they're going to save 150 billion. I mean, no doubt they cut some good some bad programs, but how much they're going to save, who knows? And then, of course, the big beautiful bill comes along, and the whole Freedom Caucus rolls over, and we now know that they're going to spend between 200 and 400 billion more per year than they were before. So whatever tariff income we get or Doge cuts we get are going to be eaten up by that. But I guess the point I'm trying to make is, when all that occurred, Besant pivoted and said, well, the deficit's really not the issue. The way we're going to manage the debt is we are going to grow. We're going to generate growth to get out of the debt. Well, okay. You can generate growth, but the easiest way to generate nominal growth is inflation. And so I think what the government is slowly but surely telling us is that 2% inflation mandate is going to get trampled. Even if inflation's printing at 3 in May, when they put in a soft Fed president, they're going to cut rates, knowing that cutting rates will lead to more borrowing, more money supply growth, and that's going to be just rocket fuel for gold and Bitcoin. I mean, I think next year gold goes to 5,000. I think Bitcoin goes to a couple 100,000. So I think silver goes to 70 to 100 over time. So, the stock market, kind of a question mark. I lean towards it's not necessarily good, because what it says is we're cutting these rates because the economy stinks. And George Gammon and a lot of others have done a lot of work that actually shows that higher rates are better in some ways for, they suggest that the economy is healthier. And I think that's where Mike was going with his comments. And there's some evidence to support that. So, it's kind of a mixed bag, Tom. None of us know how this is going to unwind, how this is going to unfold. But I feel like, all roads point to they've got too much debt. They've got too much interest expense. They absolutely have to keep the system running. And, that's why Powell is pounding the table on cutting these rates. I mean, to help out, business people. And it'll have a real impact. I mean, a lot of people have HELOCs. It'll bring more, theoretically, if the 10-year doesn't go up, which it could, but if it didn't, it would bring mortgage rates down. I mean, it could have a positive stimulative impact if they were to cut rates very sharply.
But even just taking mortgage rates themselves, I had Melody Wright on recently, and there's so many, let's say, structural issues within the housing market that, I understand the argument that, having lower mortgage rates, and that I believe it's that 5% area is really kind of that key area for bringing new buyers back into the market. But, it seems like there's so much of the, let's say, average population in the US that is basically out of money or even uninterested in houses at these prices.
No, I think that's right. Yeah. Go ahead. I'm sorry. Finish your question.
Do you think that 5% level is, let's say the savior for the housing market at this point?
Not a savior. Everything helps a little bit at the margin. And you're right. I mean, part of what's going on that's a problem in the housing market is that everybody who's got a 3% mortgage is trapped. They're not. I mean, in the olden days, I know several families that are living in too small a house, and in the olden days they would have moved up to a bigger house, and then the house they were selling would have been the new entry-level house for the young people buying their first house. And they're not doing it because they're paying 3% on the first house, and they'd have to pay, I don't know what the rates are today, but I think they're around 7%, for the second house. So there's kind of a structural issue there. So, it's a good point. I mean, 5 isn't going to solve the problem, but it helps at the margin.
So you also kind of mentioned there that, and I mean, it's a little bit, let's say, counterintuitive to some, that gold, Bitcoin, and bonds, which is the odd one, are all showing us that we're in a sovereign debt crisis. So how are they doing that, Larry?
Well, so just by the nature of their moves and the aggressive price movement on all of them. I mean, I think in the last 12 months, gold is up north of 60%. I mean, the only other time this happened was in the 70s when, right before Volcker raised rates. A big year for gold is 20 or 30%, and it's just been cooking with no signs of stopping. And then finally, silver has started to take off as well, which is a very good indicator that we're really getting to the heart of the bull market for these things. Bitcoin, same thing. It's kind of a substitute, and it's close to its all-time high. I mean, all-time high is 123. It's at 119 or something. So, and then the bonds, if you look at the bonds from 2020 to today, they've long bonds, U.S. Treasuries 20 and 30 year, they've lost over half their value. And that's just because, those bond buyers or holders are seeing that, I'm not likely to get back fair value. This bond will be repaid, but what I'm repaid with will not buy me as much stuff as, the money that I use to buy the bond with. So, when measured in bond terms, sound money assets are screaming upward and bonds are trickling downward. And so now the bond market has not fallen apart, which has kind of surprised me. I mean, but I think they've got a lot of mechanisms to keep it under control. I mean, the fact that the 10-year is still in the mid-4s is surprising to me, but it is. And I watch that carefully. I mean, if the 10-year goes over 5, we know that's a point at which they start to have pain, because in September of 23 it did, and they had 12 people talking about how the rate cut cycle was over, and they quickly talked it back down into the mid-4s. And so, my sense is that if and when they do what I'm describing with the Fed in next year, this new Fed chairman, gets very dovish, that, that will bring the short rates down, obviously, but the longer rates might actually do what they don't expect, which is to say they might go up. And at that point in time, I think the government will take a stance and say, okay, we've got to reinitiate QE or yield curve control to prevent the long rates from going up. It's just not something they can tolerate, Tom. I mean, with $37 trillion worth of debt, if rates go up substantially and running a big deficit to begin with, if rates go up substantially, I mean, this just gets really, really messy. And as you and I both know, they've got to roll over a lot of that debt in the short-term markets. And in fact, that's another interesting thing that Bessent did, was he signaled in the latest quarterly refunding announcement for the Treasury that they're going to increase the amount of short-term bills that they sell. And the reason for that is that he's thinking to himself, okay, I'm going to increase the short-term bills because I know in May of next year we're going to have a lower short-term rate. And so at that point in time, the government will have lower interest costs on those short-term bills. I'm not going to sell these more expensive 10-year and 20-year. Now, what he's hoping is that lower short-term rates will lead to lower long-term rates. And I'm not so sure he's right. I mean, that will be the $64,000 question. What happens when they do that? How does the bond market respond? I think he's hoping that it'll respond positively. I'm guessing it won't, and that rates will go up and that they'll be forced into QE. And at that point in time, it's going to be full on obvious that we really are in a sovereign debt crisis, and inflation is going to surge again, and it's going to get ugly. I mean, it's kind of the way I see it.
Well, and it's kind of ironic that initially he was very critical of Yellen issuing so much on the short end, and now that's the same thing.
That's right. I mean, so it's so fascinating. I talked about this in another podcast recently. He got read in, right? He's like, he criticizes Yellen. He gets in there, and they say, "Sir, sorry to tell you, but there's really no demand out at the long end." I mean, it's very similar actually to another thing that I think happened to them. Notice how when they came in, we're going to audit Fort Knox, right? I mean, we're going to audit. Well, that's gotten really, really quiet. There's no talk of that anymore. And I think what's going on there is they got read in that, sir, we sold some of that gold. I mean, sources I've got have said that in the Johnson administration, these are people who knew people in the Johnson administration Treasury. In the Johnson administration in the 60s, they shipped some of that gold over to the London gold pool to help keep the price down over there at that time. And Johnson was ripshit pissed when it didn't come back. But I think what happened is, again, Besant got in there, got read in that not all the gold is there. And arguably that actually is why maybe we've been, imports have surged so much. I mean, there are other reasons for this as well, but we've seen big imports out of London and Switzerland into the U.S. this year. So maybe they're trying to refill it. Who knows?
Larry, I know this is an impossible question to answer, but it seems like this situation continues and has the ability to continue far longer than we expect, than we assume that it's going to. Do you think the U.S. has, let's say, another decade of economic dominance, at least before the rubber really hits the road here?
That's a great question. I mean, and the rubber can hit the road in varying forms. I mean, it's look, we're not going to lose reserve currency status overnight. It's slipping, but we're not going to lose it. The U.S. isn't going to fail overnight, I don't think. But things can go in the wrong direction. Now, where that, what that leads to, what we don't know is what that leads to in terms of political steps. But I think I feel very confident in saying that we've got a decade of inflation in front of us. And we've got a lot of trends that are going in the wrong direction in terms of the deficit and spending, et cetera. And that unless, the Congress starts to cut spending, and really get serious about reforming some of the policies they've got, it's going to get worse. Now, how does it end? Well, that it depends on a million different actions and steps in the market and blah blah blah. But and you're right, Tom. I mean, they've been very good at kicking the can. I mean, for a data point, I thought it was all over in 2008, and here we are 15 years later, 16 years later. So, there are those who say, oh, this will continue to go on for 20, 25 years. Don't worry about it. The U.S. will always be fine and we'll win. Yeah, I mean, we are probably better than most other countries, but that doesn't mean we can't have a serious high inflationary environment that ultimately, there's enough political screaming about to, have some kind of reform or change. And so, I think that's where we're going. I think we're going to a very highly inflationary environment, and there's going to be some screaming about reform or change. Now, it may only be a certain amount of that through Trump. But then if, this fourth turning is like I think it would be, I mean, there's some chance, sadly, that, blue team will win in 4 years. And, you want to talk inflation, they're the masters of it. I mean, universal basic income, debt forgiveness, I mean, even Trump, look at Trump, one of the good things they've done are these tariffs I believe in general. And the tariffs are generating $100 to $200 billion of income for the country per year, which is good, additional income that we would not have had. Well, and so that takes the deficit of 1.8 and it reduces it. Of course, the big, beautiful bill increased it. But, Trump is starting to say, well, maybe we're going to pay a tariff dividend, to the lower income people in the country. I mean, it's like, dude, don't you realize we're running an enormous deficit, and you're talking about sending? I mean, one of the things.
What about the Doge dividend too?
Yeah, exactly. Was that too? But I mean, don't you realize that we're running this absolutely enormous deficit, and I mean, so one of the things that COVID did with the PPP and the stimmy checks is it kind of normalized the government sending out money to people just for no reason, money that it didn't have, printed money. It normalized that. It happened in COVID. Well, okay, so and it kind of worked. I mean, people were happy getting those checks and blah blah blah. Well, guess what, Tom? I think that's going to happen again. Do you know what I mean? I mean, either in this administration or the next one, times will get tough, and okay, we're going to send out some more checks. I mean, that may be fine. I mean, look, the good news is you'll get a stimmy check. The bad news is your grocery bill will go up by an equal amount. So we've got this broken system where the money is anything but sound, and that's why. To me, it all just screams at the top of your lungs that, oh my God, we've got to invest in things they can't print.
Yeah, I mean, that disconnect between cause and effect, or let's say stimulus and effect, seems to not be understood by many of these administrations.
Not by many, and that's part of the reason why I wrote the book too, was to try and explain. I mean, I feel like there are a lot of angry people in this country, and rightly so. I mean, I get it. Going to the grocery store is a terrible experience for me. I just can't believe, seriously, I just can't believe, and I'm doing fine, right? But I just can't believe my grocery bills. I mean, what used to be $25 is $75. I mean, it's nuts. It's absolutely nuts. And everyone's having the same experience because we all eat. And so, and so they're looking to lash out, and they don't necessarily, know what the solution is. And they lash out at the wrong people, the wrong thing, I mean, the solution is really just, it's this economics of the money printing, right?
Mm-hmm.
So.
Larry, going back to this discussion of basically the Treasury and bond markets here, of course, the Genius Act has been introduced and talked about a lot. The idea of stable coins creating more demand for treasuries and bonds is being pointed at by many as something that is going to save the Treasury and the bond market. Yeah. How big do you think that source of demand ends up being, especially over time? Like cumulatively, I think Tether is something like the 7th largest buyer of treasuries right now. But how long? So how long can that persist? And also, how big do you think that source of demand ends up being?
It's a really great question, Tom. And I've looked at this in great depth. So there's Tether and Circle, the two big stablecoin issuers, and as you know, they do buy treasury bonds, short-term treasury bonds, and that creates demand. So Tether's 160 billion and Circle's 60, so that's 220 total. So we're running a deficit of 1.8. We've got 9 trillion of bonds to sell. Well, 260 billion is not a big dent in that. However, those numbers, that 260 is growing at about 50% a year. So if you take it out 5 years, compound that, you'll get to, a trillion or so. So that's not trivial, in the context of a 1.8 deficit and 7 you got to roll over every year. But it's not. It's not
just to interrupt. Do you think that assuming that 50% growth per year for the next 5 years is a reasonable assumption?
It may not be. It may slow down. I mean, some of it, a lot. So let's just talk about what started that whole thing. Mm-hmm. When we seized the rush, what the stable coins really are, the big use case for stable coins, it's not U.S. people buying them, because you can put money in a money market and get 4%. If you buy a stable coin, you lose the yield on it. And that's why these stable coin issuers make so much money. I was at a show in Europe, and I learned that the big stable coin demand, Tom, happened when the Russians, we seized the Russian assets, and we shut them out of SWIFT. So you're a Russian businessman, or you're an Iranian businessman, or you're in certain countries where we're not being particularly friendly to your financial system. Stable coins allow you to make big payments on crypto rails. And so, all these, I mean, I was with some Russians at a dinner at this thing, and they said, the minute that happened, everybody became a crypto advocate, because what they realized is that they could have a crypto account. They could bill somebody and say, you need to pay me $100,000. And bingo, in 5 minutes, the transfer could occur over the crypto rails, and they had a $100,000 stable coin. That's what's driving that whole stable coin thing. And you're right. I mean, the 50% may not. So the big growth came in the early years,
Mhm.
And there will be continued growth in that area, but it may not be at 50%. It's probably slowing down. I haven't looked at it carefully year over year, but
Well, and
yeah,
there's
but it's not. I mean, the one. Let me just say, concluding, the one bottom line is, to me, the stable coin is going to save us talk that we've kind of heard out of the Trump administration and some others. It's nonsense. This is very much. It's got the same feel of, oh, Doge, we're going to cut $2 trillion, right? I mean, stable coins are not. I mean, at the margin, yes, they help. They are buyers of Treasury bonds, seventh largest. Fine. At the margin, it helps, but it is not going to reverse or solve the problem, in my opinion.
Mhm. Well, and that's what I was going to say. It's not just, let's say, Russians buying stable coins, but it's also kind of the attractiveness of the US dollar being, the cleanest dirty shirt at this point.
Absolutely.
If your country and currency, like let's say Zimbabwe, for example, has this insane inflation rate, the US dollar, let's say 10%, if you want to call it CPI or inflation rate, looks a hell of a lot more attractive to you than 100+%, right?
Absolutely. They're used in countries where the currency regime stinks. And particularly in countries where the currency regime stinks and the SWIFT or the more traditional payment rails aren't working very well. I mean, it really is kind of a slick system. I mean, you can pay somebody 24/7 very quickly and get confirmation, all of that. I mean, I still have to go to my bank to send a wire transfer and pay $50,
Yeah.
so, and it generally takes a bunch of hours. So,
and typically you end up dealing with somebody that you know how to fill out the wire transfer forms better than they do.
yeah, exactly. I mean, look, I think over time, the banking system has to really get ready to be disrupted by these crypto rails. I mean, a lot of what the banks do, it's kind of like, well, gee, why do you need a bank? But that's a whole different discussion.
So, Larry, sticking with the bond theme for right
Yeah.
now, one of the other ideas that I wanted to run by you to try to understand how that ends up working is, obviously, we've seen Japanese, especially long dated debt, really just keep going from bottom left to top right here.
Yeah, big time.
How does that Japanese carry trade how is that affected by, let's say, this new Fed dove coming in and cutting to, let's say, 2%?
Well, I think all bondholders are coming to realize that they are the sucker at the table, and so I think that up and to the right is what interest rates are going to do everywhere, because if you're holding something that represents a currency that's being massively debased and has to be massively debased in order to make the commitments, why would you do that? And as I talk about in the book, I mean, and I don't like to go here because it's kind of depressing, but um, at some point it becomes kind of a Gresham's law where, you're in a theater and, there's fire and smoke is billowing up and everyone's like, we got to get the hell out of here, or we're going to die. And so, we're not anywhere close to that stage in terms of the major currencies, but it's kind of within sight, looking over the horizon. If and it depends entirely upon the policies pursued by the governments. I mean, the governments are not pursuing policies today that would get you to anything close to hyperinflation, but that doesn't mean that they can't in the future, particularly when push comes to shove. And there'll probably be one hell of a political debate of, do we just print the money and keep the system going, or do we try to restore the soundness of the money? And there's going to be a lot of pain when we do so. I mean, that's going to be a hell of a fight. And my gut is that we print the money to keep the system going side's going to win, which then leads to, at a minimum, high inflation and perhaps currency failure. I don't like to go into dark places. And so currency failure is a dark place. I don't want to go there. I hope it doesn't happen. But it's not outside the realm of possibility if they do stupid shit. and governments are really good at doing stupid shit, right? I mean, we all know that. So, and either way, it informs your investment choice to, I don't have to have hyperinflation for gold and Bitcoin to work out. I just need inflation. And, plenty of that coming from what I can see. Now, that could change. I mean, if they suddenly got incredibly responsible, my thesis isn't right, but how's that working out, the getting responsible piece? I mean, those tried to get responsible, didn't work, so.
Larry, what are the most, let's say, ominous signals on the horizon right now to you?
Oh boy. I don't know. I mean, that's a great thing. I mean, to me, and a lot of people are going to hammer me for saying this, but to me, this whole AI thing, it really reminds me of the dot-com bubble. I mean, just we can't have enough AI. We've got to have hyperscalers. We've got to spend $21 billion a year on AI infrastructure. AI is going to replace every job tomorrow. I mean, I was around in 2000 when the internet came into being, and that bubble occurred. And I remember very clearly, we were going to run out of fiber. There was going to be so much internet traffic, we were not going to have enough fiber. So WorldCom and Nortel and everybody and their brother laid fiber everywhere, right? Because they just kind of assumed the early growth rate of clicks and usage of the internet was going to continue forever. And of course, we ended up with a glut of fiber, and all those stocks fell apart. And so I get the same feeling about AI. I mean, and don't get me wrong, we have a lot of fiber now, and the internet became an enormously important thing. And so AI will change the world, will add to productivity. It will become an enormously important thing. But boy, it really feels like it's ahead of itself right now. And so when that bubble bursts, I mean, I think the AI bubble is probably what's holding the economy together. I mean, I talked to a lot of people they're seeing their demand coming as a result of, the growth in electricity usage, the growth in data center usage, et cetera. And if suddenly all of that CapEx, if the AI bubble burst and all of that CapEx went away, we'd have a good downturn. We'd have a really good downturn. I mean, I'd love to know what percentage of all the, the computing, all the technology sales, I'd love to know what percentage of that's going into this AI bubble. I bet it's not small. And so, when suddenly we realize we've hit peak AI and, oh my God, we overinvested, look out, so I kind of consider that to be somewhat ominous.
Mm-hmm. So, Larry, I want to go back to, some of the comments from the Fed here. And we recently saw that they were talking about gold revaluation in one of the papers. And it was very, there was a lot of like negative comments within it based around gold revaluation. What do you think they're trying to signal? Or are they trying to discourage thoughts about that? Like, how do you read that?
Probably the Fed is. Yeah, I was shocked that they issued that paper. I don't, those guys might have gotten fired. I don't know. The whole issue of gold revaluation is a fascinating one. I mean, Miran wrote a paper about this. Trump has said things like he who has the gold makes the rules. Besant has said things like, we need a new Bretton Woods agreement, which is the last one, and I want to be at the table when it occurs. Besant has said things like we have assets that we could sell and revalue, which, I view as being the gold, even though he denies it. I'm sure it is. It appears to me that gold revaluation is kind of on the table and part of the discussion. I think the administration understands that we need a neutral reserve currency and that the system we've got has hollowed out our manufacturing base. And where that's become particularly acute is in these wars and how quickly we're burning through munitions and we can't replace them. Mm-hmm. And now, of course, we've all read the stories about how we need all these rare earths that only China produces. And so we're going to put tariffs on China, and China's like, yeah, that's fine. We're not going to sell you any rare earths. Mm-hmm. Ford's like, hang on a second, I need those to build my trucks. And China's like, well, all right, we'll let you have them for the trucks, but we're not selling the rare earths that you guys are using in weapons. And so, the Pentagon, the CIA, the administration, I think really understands the dilemma we've gotten ourselves into and that we've got to return to a neutral reserve currency. And I'm sure they've had conversations about a reset of gold and maybe about a reset surrounding Bitcoin. But, whether or not they've got the courage or they feel like there's the political space in which to do it, I mean, sadly, I think it's probably pretty thin. I think, I don't know though. I mean, Trump is bold and he's done bold things so far, and maybe he'll do a bold thing like a gold reset. I mean, the problem is, the gold's carried in the $40 an ounce range, today, and if they reset it to today's market, it add like $1.5 billion or $1.5 trillion to the TGA. That's just not that much. I mean, to really make it work, they'd have to go to 10 or 20,000 an ounce or higher. And whether they're going to do that or not, who the hell knows? I mean, obviously, if they do, those of us who've invested in the metal, invested in the mining companies, we're going to be, silly rich. Of course, they'd probably put in a huge tax rate on that kind of stuff. But anyway, it's a different matter. But the gold reset thesis is interesting because if you read the tea leaves around the discussions that have been had, there's no doubt that they're considering and thinking about going in that direction. Whether or not they will pull the trigger, I don't know. I think we will ultimately get to some kind of a reset like that, but I think that's more likely to come after a period of very, very high inflation where everyone is screaming about the inflation, and then they can justify it. Then they can say, yeah, you're right. This inflation really is a problem, and here's how we're going to solve it. We're going to do a reset. Mm-hmm. Right? And that, to me, that's the most likely time frame. So that's part of why Trump wants to get rates down, run inflation hot, run the economy hot. Everyone's got a job, but inflation's cooking. And then right before he leaves office, because he's probably afraid he won't be reelected, they reset it, right, to try and get things back under control. I don't know. That's just one thesis.
Mm-hmm. Well, I mean, I forget the actual math on it. I think it's every $4,000 an ounce of gold is equivalent to like $1 trillion.
That's correct, because we got 251 million ounces of gold. So mm-hmm. Yeah, that's exactly right. $4,000 an ounce is $1 trillion into the TGA.
But what do you think that actually looks like? Like gold revaluation, does that mean they sell it and buy it back at the new price? Does that mean that, let's say $20,000 becomes the new floor for gold? Like what
it's
what
really
are the
like
mechanics of it?
It's really like the magic $1 trillion coin. I mean, it's mechanical. They just print the money and put it in the account.
Right.
So, but if they want to make it hold at that level, as Groman has pointed out, and as I agree with him on, they would have to say, okay, we stand ready to buy and sell an ounce of gold at $20,000. Mm-hmm. You bring in $20,000, we'll give you an ounce of gold. And in turn, you bring in an ounce of gold, we'll give you $20,000. I mean, they would have to make a market in gold, literally. And then what they would see is, did they get inflows or did they get outflows? And what that would tell them is, is 20,000 the right number? Mm-hmm. Right? If it's $20,000 and everybody's giving them gold and getting the dollars, well, then they set it too high. But if it's the other way around, if everybody is saying, give me the gold, here's your $20,000, give me the gold, well, then they set it too low, right?
Well, and that's what I was going to say is, like, how many people at that point do you think are really going to be willing to trade their gold for that $20,000?
Well, some people will. I mean, if it turns out that some people will. Some people will say, "Hey, Jesus, I got that's a lot of money. I'll do it." I mean,
but it's more of a comment on what is the dollar really worth at that point.
Well, that's right. That's right.
The value of the dollar,
and it does. But again, and by the way, it'll be massively inflationary when they do that. But it's a one-time thing, and you've returned to sound money. I mean, chapter 22 of my book talks about this. I mean, we need to do a reset, right, Tom? We've got way too much debt. We've relied on this broken Keynesian model. The way that the interest rates should be a function of supply and demand, of saved capital. And they're not. They're set by a central planning committee called the Federal Reserve, which is just stupid. I mean, it's not free market. I mean, our kids are going to think we're nuts that we did this. And so, basically the market price of all these things should sort itself out if they were free markets, but they're not. Mm.
So Larry, as we're talking about inflows and outflows, we've seen a lot of gold ETF demand and inflows this year. Is that a sign of this bull market getting healthier and let's say broadening
Absolutely.
out?
So in my quarterly report that you referred to, you can see that there's some real serious demand coming in out of China and Asia. I mean, those people, they love gold and they've been seriously demanding. In the US, the ETFs have been pretty dormant. There hadn't really been much demand. It's starting to pick up. Mm-hmm. You're seeing signs. I mean, Costco had gold bars for sale, and usually when they get them in, they sell them out pretty quickly. I mean, I think, I've had a lot more inquiries about friends. How do I buy gold and so forth. So, I would say that we're starting to see a broader interest in gold, investment managers, et cetera. So yeah, it's clearly coming, but it's not at the point where the shoeshine boy is recommending gold or Goldstocks. Do you know what I mean? I mean, it's still very obscure, and there aren't, other than guys like you and me and people who listen to podcasts like this, most of the world doesn't get this, still. So we got a long way to go.
I think another interesting sign of that is, let's say, silver's continued march upward.
Yeah.
And I think realistically, that $40 level for silver as well as the $4,000 level for gold are going to be big psychological.
Completely agree.
Not only floors, new floors, but also resistance levels. So do you think that, when we achieve those two targets, that also brings more momentum and interest into the space?
Absolutely. Absolutely. I mean, the fact that silver is now starting to confirm the move in gold, I mean, gold moved first and silver's following through. Mm-hmm. That's huge. I mean, I am so bulled up on silver right now, Tom. As I told you, I listened to your interview earlier, with Gary Savage. And, I mean, yeah, silver's going to 50, 70, 100, soon. And that's a big deal. And yes, I agree with you. I think psychologically, I mean, up until now, what people have been kind of saying is, well, the gold market's a bubble, and a lot of the analysts in Toronto who are following these mining stocks, oh yeah, it broke through 2070 to 2300, but it's coming back down to 2000. They had all their models built on 2000. Well, yeah, it made it to 2800, but it's still coming back down to 25. Well, yeah, it made it to 3200, but it's coming back down to 3. Well, yeah, it made it 34. Pretty soon they're going to say, holy shit, there's something bigger going on here. This is not coming back down. Mm-hmm. We're not going from 3,400 to 3,000. We're going from 3,400 to 4 to 5 to 6 to 7, Now, which is not to say there won't be corrections along the way. I mean, could we go from 3,400 to 3,000? Absolutely. Mm-hmm. We could go back to 2,800, but I don't think we'll go below that. But in a seesaw fashion, I mean, gold, all bull markets try and shake off as many riders as possible. So most people should be aware about the time they feel like they got to own it. Well, then there's going to be a correction. But, if you take a long view on this, I think we're going much higher in both of these.
Yeah. I mean, you always think about the worst case scenario, a major market crash or some type of quote unquote black swan event that nobody saw coming. I think there is a possibility that a lot of the markets, gold included, miners, silver, all get, washed a lot lower. But to me, this is only a one-way train, really. Like there are going to be some steps back and some sideways churning, but the math ends up just working out in gold's favor as measured in any fiat currency.
I think that's right. I mean, I think, I hesitate to say it's different this time, but I think there are fundamental underlying drivers here that you need to understand to recognize that this is going to go further than people think. And it's been a long time coming. And by the way, some of these charts are just absolute things of beauty. I mean, you look at the silver chart, mm-hmm. It's just a long rounded bottom with a cup and a handle and now a breakout. And I mean, $100 is like falling off a log. I mean, it could go to much higher than that. So, and by the way, I mean, most of the companies I own that mine silver, I mean, the cost to mine was $20, $25 an ounce. $32, they were kind of getting by. At $100, they're going to be making some profit. I mean, to tell you, right? I mean, it's going to be, their costs will go up, by the way, because there's inflation on all their inputs. But they're not going to have inflation of 500%. They're going to have, or of 100%. They're going to have modest inflation, and the price of the metal they're selling is going to go up, 2x or 3x.
So Larry, let's talk about miners. There, you had a chart that you wanted to share with me as well.
Please. Let me show this chart. I think this is a really important chart. It was in my quarterly report, and so what this chart is, and I'll just describe it for people who are listening on the radio. This is a chart of the price of gold compared to the HUI Gold Stock Index, the broadest index, starting in early 2001, going to present. And what you can see, there was a bull market from 2001 to 11. And then there was the bear market, and then there's the bull market that started kind of in 2016, and we're in it still. And what you can see back in the one from 2001 to 2011 is that gold went up, but the stocks went up even more. And that's because they represent streams of gold, and gold just sits in a vault and doesn't reproduce. What you can see from the bottom in 16 to the present is that gold has gone up quite a bit. And the stocks, the response of the stocks has been quite muted. They've underperformed gold in terms of appreciation. And so there's a big kind of alligator jaw difference between the price of gold, which is at 3,400, and the HUI, which is at 400-ish. And so my expectation is that as people come to realize that prices are going to go much higher in the gold market, these stocks are going to catch up. And the stocks are still looking in the rearview mirror thinking, oh, this gold price isn't going to last. But once they realize it's not only going to last, but it's going to go to 5,000, there's going to be just a very aggressive and massive move in these stocks. And so I am really, really bulled up. My fund is probably up to 70% so year to date, but honestly, from where it is right now, I sincerely believe it could double in the next, 12 to 18 months. I think it will. And that's just because of the catch up. These gold and silver stocks have really lagged, the underlying movement in the price of the metal. And I'd say one of the reasons for that, I mentioned this before, is that this used to be the only way to play alpha on monetary debasement was gold stocks. Gold would go up and the stocks would go up more. So everyone wanted to make more than just the price of gold going up. They buy gold stocks. Well, that's not really the case anymore because Bitcoin exists. So if you look at gold stock investors, they're generally over 40 or 50 years old. And so all the young people, they're not buying gold stocks. They're like, screw that shit. I'll just buy Bitcoin. I understand that argument, but it means that there's less interest in these things than there used to be. But all the same, I mean, the big pools of money. I mean, right now the entire gold stock market is about $500 billion. In the context of a stock market of closer to $50 billion or $50 trillion of value. So, it's like 1% of the total value of all the stocks outstanding. And so, what's going to happen here? I mean, these people, these algorithmic traders, these algorithmic managers and others, they're going to look at like my report and they say, hang on a second, you mean to tell me the S&P went up 6% and gold stocks went up 50% in the first half of the year? Shit, why don't I have any of those? I mean, and that doesn't mean they're going to sell all the S&P and go buy gold stocks, but it means they're going to go from a 0% allocation of gold stocks to a 4% allocation. And, that 4% is not a small amount of money given how small the market for gold stocks is, if you see what I'm saying. So, I'm extremely bulled up on where this is going. In the next year or two. Now, having said that, there will come. I mean, you want to rent these stocks. You don't want to own them over full cycles because at some point in time, they will become overvalued, and the price of gold will stop going up as much. And so, there comes a time to sell them too. But we're not anywhere close to that. I think in my report I said it's a 9-inning game. We may go extra innings, and I think we're in the third inning. So,
So Larry, what do you think? Trying to be objective about where we are and what could happen here in this market yet, like in the precious metals market. What could go wrong yet?
What could go wrong? That's a good question.
What could derail this bull market for a meaningful amount of time, not just a short correction? Yeah.
Well, I mean, look, a total economic collapse. Kind of a la 2008. I mean, and I don't know what you define as short, but in a real liquidity crunch wherein they don't respond by printing money, everything's going down. Just everything is going down. Kind of Great Depression style stuff. In which case, even the price level is going down. You have deflation, and in which case, owning cash is your best bet, or government bonds that you can get the principal back. I have made the assumption that in a democratically run system like the one we have, the Federal Reserve will never allow that to happen. They cannot allow that to happen. But that still doesn't mean it can't happen. So, in 1929, what you wanted to have was cash because, in 3 years later, you could buy everything that was out for sale before for 10 cents on the dollar. I had a grandfather who bought a house for 30 cents on the dollar, because the housing prices collapsed 66%. So, so it's a massive depression, a bursting of a bubble followed by massive depression could hurt all of us who are long anything. I'm making the assumption that the policy response would never allow that and or would likely lead to massive printing, which would then lead to massive debasement, which would then lead to these things being the new form of money. So, that is an assumption I'm making, but if I'm wrong about that, you want to hold cash or bonds, So, but even the bonds, the government bonds probably won't default, but other bonds might. The nice thing about gold is it's cash that they can't see, it's cash they can't take away from you. And I think honestly, I think the price of gold would hang in there pretty well, even in a depression. So,
excellent. Well, Larry, is there anything else that you'd like to?
No, nothing else. Obviously, I want to try and sell my book. I published this book in February, approaching sales of 40,000 units. Those who've read it say it's a good book. I wrote it because I wanted to try and return to a sound money standard. I think it'll make the world a much better place. I want the world my kids are growing up in to be a better world than what we're seeing right now. And so this lays out how we got here, and then it lays out how to protect yourself in using gold and Bitcoin. And it's available on Amazon. It's hardcover, soft copy, ebook, and audio. So obviously, I've done it because I want to try to help people, and I think if you read it and you like it, you should give it to family members and friends. I mean, we've got to spread the word. I mean, this monetary event we're going through, it could be kind of painful, and that's sad for many people. And so, the more people we can get prepared, the sooner we can get through it, the sooner we can return to sound money, the better the world will be, in my opinion. And the book kind of talks all about that. So that's my sales pitch.
Well, Larry, I appreciate your efforts in trying to, help people and also, educate them on where we're headed and what can help protect you on it.
Yeah. Thank you, Tom. Thanks very much for having me on the show. I always enjoy it. And I know you got a great audience. I'm very supportive of all the gold and silver people, all the gold and silver investors and mining investors, et cetera. I mean, stay with this stuff. We're going to be fine. It's going to work well.
Absolutely. And of course, our discussion today was based a lot around your quarterly reports. Those are all available at ema2.com, and excellent Twitter follow as well at Lawrence Lepard. Larry, thanks so much for your time today. I always appreciate it.
Thank you, Tom. Really enjoyed talking to you. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.